Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Reid Goossen. Now, Reid is an Australian real estate entrepreneur, investor, author, and public speaker. He got his start in real estate back in 2012 when he moved to the US. And since then, he's gone on to start two multifamily syndication investing firms, which have been involved in the acquisition of over $650 million worth of U.S. real estate. He also hosts the Investing in the U.S. podcast, where he interviews top real estate investors to help educate entrepreneurs looking to break into the U.S. market. You guys, with that, it's my honor to welcome back Reid to the show. Reid, how you doing today, my friend?
Mate, absolute pleasure to be back here, man. I was thinking, was it a year ago that we saw you in Florida?
Yeah, you came to visit sometime. Yeah, definitely in the past year and a half. Yeah, you were in town for something or another, and we grabbed a beer together at a local.
And you showed
brewery
me a garage that you owned.
That's it. Yeah, we just must have just closed on that garage, and which was an exciting acquisition for us right in our backyard. We very rarely ever get to work in our backyard, which is crazy.
Yeah.
I mean, I love the Tampa Bay area. We haven't done a lot of acquisitions here local to home, and that's a big one. That's kind of like one of our trophy assets. We're really proud of that one. So yeah, but a little over a year, my friend. So how you been? Life is very different from you from when I saw you a year ago. And so maybe get us back up to speed for those, maybe start by, for those that aren't familiar with you, maybe tell us a little bit about yourself, but then ultimately I would love to get an update from you on, both personal, you got some big, awesome things happening in your personal life, but then, professional as well, kind of what you guys are up to.
Yeah, sure. So 30-second elevator pitch, as you mentioned, moved to the US in 2012 to chase a girl. She became my wife. And in that time, so my background's in structural engineering. I moved here without a job, just had there's an Aussie visa between America and Australia. And I just wanted to live in New York for a period of time. I was 26 years of age. It was 10 years ago. I'd already been bitten by the real estate bug, and I moved here and I thought, geez, look how cheap this real estate is, and bought my first property for $38,000, with, I think I was earning 65 grand a year at a structural engineering firm in New York City. Went on to, grow two different real estate investment companies here in the last decade. Been a lot of hard work, a lot of ins and outs. Got a lot of good stories and a piece of advice for people who are looking to break out of the W-2. I had visa issues as well. So I had an extra layer, but I moved here with, very limited resources, didn't know anyone, and just, made it happen. And I don't say it to boast. I say it more to, inspire people. And so that's sort of the elevator pitch. The last 12 months since I saw you, originally I founded a company called Wildhorn Capital with a good mate called Andrew Campbell. We have sadly parted ways, but it's for the best. And I've started another company called RSN Property Group. And I've closed on just shy of $100 million of assets under management just this year. And to top it all off, got employed new people. Became employing people is obviously difficult, and salaries and all that sort of stuff, as you know. But then we also welcomed our little baby girl here 5 weeks ago, which is insane to say that I as an entrepreneur, doing it all, and coming here just about before Thanksgiving, and it's been a whirlwind 12 months since I saw you. So so lots going on.
Yeah, that's a lot, my friend. Maybe we dissect that just a little bit. I think first and foremost, congratulations on the birth of your daughter. That's super exciting. It's funny, just I think entrepreneurs maybe can adapt a little bit better to new fatherhood, given the experience of just going through some of the ups and downs of owning your own business than maybe that of maybe someone just works at W-2. And so I think that we're a little bit better prepared, but even then, it's unknown territory, right? And right. You kind of go day by day through the motions, lots of emotions, both with the newborn, with your spouse, and just trying to juggle those two things, with your business. And so I would love to maybe get, and maybe you're not into it far enough. Again, I think you had mentioned she's 5 weeks old now. And so you guys are still trying to get some traction. Your wheels are probably still spinning a little bit, right? But you've had a lot going on over the last year, and just really getting a sense from you as to, how you've been able to maintain and juggle all these different balls that are in the air. Would you mind, some context if you would?
Yeah. So obviously the biggest ball juggling was this the leaving of Wildhorn Capital. It was emotional, but for the best. And it was one of the hardest things I've probably ever professionally as a business, done. It's you build up a big portfolio, and you ultimately, We had different visions, and that's fine to have different visions as two founders, and you ultimately go in your separate ways. But it was tough to negotiate an exit and to ultimately walk away. And those guys are going to do just freaking awesome, and I wish them all the best. But for me, I just knew that where I wanted personally to be in 10 years' time was probably going to be different to where my former business partner was wanting to be, and that's okay, right? You
Yep.
form partnerships in the beginning because you have no money, right? You still work in W-2 jobs, you've got a side hustle, so partnerships are really, really important. Coming 2.0 now, like I do have a new partner, but he's a minority partner, and it's really about my vision of what I want for the company, and then having a bit of money behind me to go and employ good people, right?
Mm-hmm.
And create a team. So you asked about how the balance is going with the newborn. Well, it's actually going better because we spoke a little bit in the green room before switching on the mics. That stuff or the BS falls away, right? I tried to take a couple of weeks off for maternity leave, and now having employees handling certain things, like I only saw the most important stuff that rose to the top.
Mm-hmm.
And now that's not perfect by any stretch of the means, but I can see it's working, right? So employing a team, having good people around you, learning lessons from my past partnership coming into this, the new Reed Goossens 2.0, I think has made me feel comfortable with the decision of leaving, but also the decision of employing good people to surround me, to help me take me to the vision I want to go to. And then, having balance in my life, with the family and trying to take a couple of weeks off for maternity leave to be present with my child, is all we're all learning, but but lessons of being an entrepreneur has helped me sort of adapt along the way.
Yeah. No, I appreciate you sharing that. And it's funny. Reed was very quick to point out that I started telling him when we were in the green room that, prior to last summer, this isn't, the birth of either one of my two boys, but just speaking to, kind of being able to step away from your business and having, a good set of employees and a business partner, someone that can, basically, make up for any voids that you're stepping away ultimately creates. And last summer was the first time I've ever taken more than, call it 7 or 8 days off consecutively, to where I've truly have, for the most part, stepped away from the business. Last summer, we took 2 weeks away, spent a bunch of time with the family at the lake up in the mountains, and truly very, very small amounts of checking in, early in the morning for anyone woke up, or maybe late at night after everyone had gone to bed. But, and this summer, we're pushing it. We're going to do a 3-week vacation where we, again, unplug and really just focus entirely on the family, my boys, my wife, and just, cherish that time together. And Reed was very quick to point out that that's just a failed American mentality that we struggle so much of getting away for even more than a week, right? Like, in a week is like a stretch for most Americans to think that, like, how could I ever step away from my job or my business for a week and the whole world doesn't implode? Well, and there's some truth to that, right? Like, we are one of the, the only countries that really think in that manner. Most Europeans or Australians, I mean, you guys are used to holiday, man. Like, you guys are like, let's 2-3 weeks a month. Come on, like we're backpacking for a couple months all the summer, right? And we're fine. Like, everything works out.
Well, I think it's so true. I remember when I went on my honeymoon and I was here in the States, and it was 2019. I had to physically turn off all my emails when I spent 2 weeks in the Philippines, and that was the biggest ripping the Band-Aid off, because I'd have to go and physically turn them back on to get them, and it was such a good way to be like, I can't, like, it would take me 30 seconds to a minute to turn them all back on. And I knew I couldn't do that. So it was like a barrier for me to doing that. So I'd say it with jest. I love giving Americans a little bit of stick for it, but you guys have got to learn, like, it's the part of building a business is, we all get into this game, and for all the listeners listening out there, like, you're getting into it for financial freedom, right? And I think if the goal isn't to be if you're the cog in the machine that runs everything, then if you keel over and die tomorrow, the machine's dead, right? It's not a business at that point. It's not a business. You've just created yourself another job. So there's increments that you have to move in. Obviously, when you start a business, you become a sole entrepreneur. You do everything in the business. You can't let anything go, and it's very hard to bring on extra help or ask for extra help. But as you start to learn to do that, you start to let go. And then that means, like, oh, hang on, this is what I wanted life to be. I wanted to be able to go pick up my kid from school, or go and take a week off or 2 weeks off, or travel back to, wherever it might be. And it's okay that things aren't going to fall off, off the face of the planet. And that's hard as an entrepreneur. But then as being an American entrepreneur, it's like you're told to hustle, and it's got to be like,
Yeah.
I always joke with my wife, and Thanksgiving's coming up, right? And usually most Americans take the Friday off, and you get back to, I remember getting back to the calls on the following Monday, and everyone's like, "Oh, I'm so relaxed. I just had 4 days off." I'm like, 4 days, like probably took you 4 days just to unwind. You're probably just at the point now where you're like, okay, I can now, mentally let go of all the stresses of the business. And it sounded like when you had took that 7 days off, you only just got to that part at the end of the 7 days to be like, oh, I know what this feels like now.
No, that's the truth. And like you said, all the important things really rose to the top. I mean, again, last summer we took, it was 15 days in total. And what I found is that like the things that were absolutely critical that needed my involvement, and most were, and there was only a handful. There really weren't that many. Is that those things really rose to the top, and everything else that in a normal day to day that we would have maybe labeled a higher importance on just kind of trickled away. And if they were really all that important, they came back to the top later on down the road, a couple of weeks down the road, and we addressed them at that point. But they weren't fire drills. Like very rarely is anything in your business ever that much of a fire drill where where things are going to take a turn for the worse if you don't interject or step back in, if you stepped away for a few weeks for vacation. So no, it's lesson learned. Like I told
Yeah.
you, this week we're going to stretch it another week, and then ultimately the goal. And you mentioned just rip the Band-Aid off, which I love that. I love every bit of that. Is I love to take the entire summer and go to all the state parks with the family, get a big Class A, and go. I want to do that's on the list, and we're going to do it. And but I guess the American in me is kind of easing into it over the next year or two.
Putting the dip in the toe in the water. The other
Yeah.
thing I also have has helped is putting up barriers around or setting expectations with employees to say, hey, look, I'm going to be available for an hour,
Yes.
4 days into the trip, 2 hours. I'm going to get on a call with all of you, bring me what you got, and then it's going to be another 4 days before I talk to you again. And that can then, maybe that is the easing into it, right? Like you then set up the boundaries to say, look, this is the time I can speak to Kevin. We can just hash it out, boom, and off we go again.
I love. Did you actually implement something like that when you went to the Philippines for 2 weeks, or no? Like you just
No. Like it was that was completely honeymoon.
I hope that I was about to give you a heck about that on your honeymoon.
My wife would have my new wife would have killed me. So
yeah. So switching gears a little bit, I'd love to maybe get an update. We've gone through a couple, not necessarily volatile years, but just unique years, not necessarily volatile in the asset classes that we're in, because they ultimately outperformed, right? Like they did exceptionally well during COVID. Now we're in a post-COVID era, but now we've got a little bit of a different type of turbulence that we're facing here, and it's more of an economic turbulence as it relates to the debt markets, right? And there's just a lot of changes happening, and there's a lot of uncertainty as to not necessarily what the next 3 months look like, but I think what the next 1 to 3 years looks like. And so maybe talk to me about kind of your business today, how you guys are adapting to these ever-changing times, and then what's it look like in your I hate crystal ball. It's such a stupid way to phrase it because no one's got one, right? But like, what does your business model, like what does your vision look like, seeing it through your lenses over the next 1 to 3 years, and how does your business follow that path?
So let's start with where we've come from, right? Like obviously we've had historical inflation. I think we've had the Fed has a mandate. I'm not commenting on whether the Fed's doing right or wrong. It's just it is what it is. But they're trying to stamp it out, and we've seen unprecedented, fourfold Fed rates in less than 12 months. It's going to have a massive impact on debt markets. It's going to have a massive impact on financial instruments in what we use in our everyday business. So, looking at the beginning of the year, I probably could have got a 3.25, 3.75 interest rate deal, loan, floating, probably 75 to 80%. I'm probably buying at cap rates around the 4% rate range, where we're all value add. Today, we've got guys who are, maybe cap rates have come up a little bit, maybe 100 basis points, maybe low fours, mid 4.5. And I do value add multifamily across, many different markets. But the same debt is now at 6.5%. And so that arbitrage between, you're going in cap rate and your interest rate is too high. I will always say the deals that we do, including probably yourself, you do sometimes come in with a negative arbitrage because you're building a value add plan and you believe in your business plan. And, the maximum arbitrage might be, you're buying at a 4 cap and you get interest rates at 5, right? You can fathom that because you say, okay, the next 12 months, I'm going to do X, Y, Z to the property and I'm going to increase the NOI and I'm going to be able to right that ship. But today we're still seeing such that the arbitrage is so large. that it's becoming a standstill with,
Yeah.
like, there's not a lot of volume being done. And I'm talking to brokers in Central Texas. I'm talking to brokers in Phoenix. I'm talking to brokers in, the Carolinas.
I
And
mean, just real quick, we're looking at we're talking like a 200 plus basis point, negative spread nowadays, right? Given,
correct.
yeah,
Or
got it.
more.
Yeah,
Or
more,
more.
right? Or
Yeah,
more.
right. Like, so we have seen cap rates starting to come back up on certain vintage asset classes. Like, you've gone from a 4 to a 5 cap on maybe 1970s assets, but you still got that negative arbitrage going on. And people are just like, I'm not, including myself, I'm not willing to pay. I just can't make the deal pencil when I'm being quoted 65% leverage at 6.5% interest, and the fact that it's floating and I've got to buy a rate cap and it's very high octane. So right now you're seeing a lot of pricing discovery. A lot of people like, oh, hey Reed, have a look at this deal. It's off market, blah, blah, blah. And it's like, I had a deal coming the other day. It was $30 million in Phoenix. We penciled out roughly about 200K a door, and that was a 4 cap. I could only pay for it today with 6.5 interest. I could only pay $26 million for it. Do I believe it's worth $200,000 a door? Yes, because it's a good area and I just know the area really well and I believe in the business plan. But what I can pay with my lens today was $4 million less. And so they're just like, okay, thanks. It's not a deal.
Mm-hmm.
So the deals that I am seeing getting done are people who are coming into strife with either their rate caps are coming to an end, or their debt is maturing and they've got to, they can't refi, so they've got to sell. And so what we are seeing, you're seeing some deals getting done, but you're either seeing guys with big funds coming in and paying all cash and not even worrying about the debt market,
right?
Or you're just seeing lower leverage, trying to get the lowest leverage, the lowest fixed rate interest you can get, which is sort of backing you into about a 50% leverage today on certain product. We just closed on a deal in Greenville, South Carolina. We got a 5% fixed, 65% leverage on the total cost. And that was we locked that in July. That same product today is now 6.5% interest fixed. So there's just been some huge swings, again, going from 3.5 in the beginning of the year now to 6.5. The system is coming to a grinding halt. It's working. So
just for those that are listening that are maybe just getting started, provide some better clarity as to the difference. You got a 5%, rate on your loan. Today, that same loan would be 6.5%. Talk to me about the buying power there. Like, how much of a difference of buying power are we talking? How many millions of dollars?
Well, not even buying power. Just think of the debt service, right? So on that same $22 million debt, I'm paying an extra $360,000 a year. Right. So what you're seeing in real time, and I have a deal that we're doing this. I bought a deal at the beginning of the year. Interest rates have risen quicker and hit my rate cap faster than I can get my business plan implemented.
Yep.
And that's happening across all different asset classes.
We just had a deal fall apart for that reason. Literally, the timing of actually getting this thing to closing, getting through just the basics of the PSA with the seller took them a little longer than anticipated. In that time, they jumped up 75 basis points, and then now where we're at, like they're 150 basis points higher than when we originally started, and now the deal it does not work at the price that we're under contract for, and so it's just we've seen a lot of it too. Like I don't know. The waters are so turbulent and the times are changing so quick. It's very difficult to execute upon, even just getting to the closing table before the rug gets pulled out from underneath your feet. That's
right. And so if you are in a deal that you're operating, you bought within the last 12 months, and I've got deals that like that, I'm seeing two things are happening. One, we're trying to continue. We still believe in the fundamentals of real estate, right? First and foremost, there is a housing shortage. Interest rates, not just in multifamily or mobile home parks or self-storage, are going up. They're going up for first home owners. So less people are moving houses, right? Guess what else is not happening? A lot of construction starts. Look at the lumber prices. Lumber prices are down in the 400s. Like, new builds are not coming online because that floating rate construction loan that multifamily developer had is now costing him a lot more, and probably shelving a lot of projects. So we're actually seeing more renters in this environment. So that's still good. And I still think that is the fundamentals of that we need more housing in this country. We need more housing across most of the Western world. But in this country in particular, I think I saw a stat, like we need like 3 million more multifamily houses or single family houses built to sort of meet demand. And now with everything sort of slowing down because of high interest rates, which is what the Fed wants, right? It wants a bit of a handbrake on the economy. So it's working, but then you're going to have all this pent up demand. So where do people go? So we still believe in the fundamentals. You've got to be able to tie up the debt with the deal at the right price. So what we are seeing in deals is that your cash flow out of the gate is probably null and void. If you're coming in with a bigger negative arbitrage, it's going to take you longer to get to cash flow positive. And so thus returns are coming down, and you're looking more as an equity play for the long term. If you believe and you want to park your money, you want, protect your money from inflation. So the fundamentals are still there. It's just about how you go off and make your cake, because the ingredients are different today.
Yeah. Are you seeing more assumptions, loan assumptions come to the table? Like I feel like the asset now, maybe some of the loans that were placed in the last couple of years that still, maybe it's an agency loan or even a CMBS loan, but it's got 7 years left on the term. Maybe it's in the 3s or the the 4s, depending when they place the loan. That now that becomes more the asset than the actual real estate itself. Obviously, the physical real estate has to make sense, but looking at the the negative arbitrage versus just assuming the existing debt now looks a lot more attractive than what it might had a year or so ago. So are you seeing a lot more of that?
100%. Yeah, like I'm actively seeking those deals.
Yeah,
like because
I got you.
I've got investors still saying, "Hey man, I've got 1031 exchange, but I need to place it. I need to I've got investors still with money, and there's money on the sidelines." It's just trying to solve for the debt. So if you can go find a deal where the seller wants out, and you got to understand why the seller wants out, because if they've got a 3.5%, 4% interest, you'd be like, you should be printing money right now, right?
Yeah.
So why are you getting out? Is it just getting a run on the board, or what's going on? So you got to be a little bit cautious, because if you truly did finance it right and bought it at the right price, then you should be sailing pretty sweet right now. Yeah. But they're the deals we're looking at. We're also looking at tax abatement deals. So deals where we are going into certain states where the AMI is increasing across the country, obviously as inflation hits, and the average 1, 2, and 3 bedroom affordable is actually quite obtainable in terms of the certain areas that we're looking at, either Austin, Texas, Phoenix, or the one in Greenville we just did. It's in a state with high real estate taxes. We can come in and impose a self-restricted rent limit. We can still have our cake and eat it too. We can still increase rents $200 because they're so low below the AMI, but we get to have our real estate taxes completely wiped off, which helps cash flow. So there are other things we're doing. We're also looking at LIHTC deals, which are burning off in the next 3 to 5 years, right? They're really a good play because you're getting at a good basis. Yes, you might not cash flow for a period of time, but if you get at a good basis, when the LIHTC burns off, you can bring it up to market and then sell it at a profit. And quite a nice, handsome profit. So
for those that aren't familiar with that terminology, please explain more.
Yeah, LIHTC. So low income housing, what's this TNC committee? These are across the country. HUD has implemented affordable, developers. They've incentivized them to go out and build these deals. We call them LIHTC deals, low income housing deals. And those LIHTC tax credits are usually placed on these deals for 15 to 25 years. And those credits are for those initial builders and developers who took the risk. But as those deals are coming to the end of their useful term in the LIHTC world, they burn off, right? And so when you're renting to a resident who earns 30% of AMI, they might be. I looked at a deal in Phoenix the other day. I saw a person earning in a 2005 built construction deal in Peoria, Arizona, really, really awesome part of Phoenix. $250 a month for a 2-bedroom.
Wow.
I could go in tomorrow and do absolutely nothing and increase that over $1,000, right? So yes, you're buying that deal. That deal was coming out at a sub 2 cap, but the reason was because there's so much, it was about to burn off in the next 36 months, and all the in-place tenants, all the covenants was they had to get their tax write-off in the beginning, they had to rent to 20% AMI, 30% AMI, 50% AMI, and thus their rents are really, really low, which is fantastic. But as an investor, I'm looking for the opportunistic side of it to say, okay, well, this is burning off and I can bring it up to market.
Have you seen have you followed the strategy, just kind of mapping it out of the one that sold for a sub 2 cap? Obviously, they're paying $250 a month. Market rents are probably in like the $1,600, $1,800, maybe even more than that for that 2-bedroom, 2-bath. Maybe it's closer to 2,000 or more. And so you're talking about a massive turn. More than likely, you're probably going to turn the large majority of that existing tenant base. My guess is that there probably could be some fears, PR lashback that would come with such a aggressive turnover. So walk me through that strategy
Mhm.
on a deal like that, or maybe a case study of one that you've seen go from incredibly low rents, such as a couple $100 a month, to a couple $1,000s a month in a market such as like a Phoenix or surrounding areas.
And I will put my hand up and say, like, we're just starting to scratch the surface of this
Yeah, yeah, yeah.
particular strategy, but we are talking directly with our property managers who have been in the business for over 35 years. So
Yep.
they have done it many, many times. And you're not coming in and ripping off the Band-Aid. And to your point, PR is the biggest issue, right? What you can do is more implement, particularly on those lower, the 20% AMI type of units, and say, like, look, the market is here. We're going to increase you $600 to $1,000 or whatever it might be. It's still well below market, but you're going to have to work with us here. And it's not just a ripping off the Band-Aid, but it's nearly like a new lease up. You're sort of going to have to get, some tenants are not going to be happy. We know that. So maybe you offer to help them move, to offer services to help them into a different community or whatever, give them a couple of $1,000 to move out of that unit, in order to accommodate and have a bit more of a lesser harsh burden, on those residents who just probably can't afford it. These are probably fixed income folks, and I'm not trying to be the big bad landlord, but I'm also trying to understand that this is just where we're at in the market, and what the market rate is versus what we what you guys are paying for it currently. So it's a more of a surgical, methodical, very thought out way of approaching those types of deals. It's not just like a value add market. It's like, let's just go and jam the rents and don't even think about it. You've got to think about the tenants. You've got to think about how they're going to react. Can they pay for it? If they can't pay for it, can we help them and provide services to move into other accommodation that's in and around their budget? So
yeah. I think I'm just a little bit more sensitive to that topic, only because for whatever reason, manufactured housing residents are much more sensitive, not from an affordability standpoint, but it's different. They own their home. We're increasing the underlying lot rent, and that's gained a lot of PR traction over the last like 5 years. And there's been many different groups such as ours that have been in the crosshairs of these different agencies that are, looking to put rent control mechanisms in place in different markets and things of that nature. So when I think of, going in and buying a mobile home park where lot rent's $100, we're going to, push it to like $700. I know what's going to ensue there. It doesn't matter. It doesn't matter what I do proactively. We can go spend $5 million on improvements, and I can still promise you that
someone's going to have a problem.
Someone's going to egg my house. Like, they're going to break window. I mean, like, it's going to be disastrous from a PR perspective, but I think our space is a little different than
it's the same thing, right? You got to tread lightly. Not, you can't just be like expecting no kickback of you're buying something with 20% AMI rents and all of a sudden you're trying to jam it to market. It's a great business plan, but there's just the implementation of that, and it's very, very sensitive. So every deal will be different. Every way you manage it will be different. And it really does come down to the right property manager who you're employing and the right community manager who you've got coming in, who's dealt with this in the past, can explain to the residents and show them, communicate that this is happening. And we're here to help. You'll still get people who are pissed off, and you're still going to get that. And that's just the way of life. So
this is kind of a loaded question. And I know the market's changed a little bit. There's you probably have realized there's still a major appetite for multifamily, right? Like, there's still a lot of capital floating around looking for a safe haven, a safe home. And so, but I'm sure you've seen a little bit of a downtick maybe in total number of bidders per property that comes out the market, right? But even then, so like if it used to be 50, now it's 15, right? Or 20, like it's still fairly competitive, right? You still got it's not like 1 out of 3 people bidding on it, right? Like there's still probably 10 plus on any decent property in a good marketplace. And so with that being said, the deals that you actually make offers on and ultimately doesn't get awarded to you or your team, making the assumption that most of the time, not all the time, most of the time the deal is going to be awarded to the highest payer, right? They have to be, assuming they're a qualified group, right? They've got a track record, but if that's the case, all apples being equal, everyone that's bidding, it's a qualified group, the highest payer is probably going to get awarded that deal. And a lot of times, the highest payer there might be a delta of hundreds of thousands, if not millions of dollars between what that end all bid was versus maybe where your offer was. Help me. Again, I told you it's gonna be a loaded question, so there's not gonna be a direct answer here, but help me understand some of the reasons why, that the buyer that got awarded the deal might be able to pay millions more on that same property than what you might have offered. Assuming that you've kind of got to your stretch point, right? Like, this is our maximum offer. Like, we can't go any higher than this. Otherwise the deal just, it doesn't pencil to us. How does it ultimately pencil for that other
Yeah,
buyer?
in my experience, what I've seen, if you're coming and getting blown out of the water with multiple several hundred thousands or multiple millions of dollars, is probably it's a 1031 exchange buyer. Like, they extremely sensitive to, they've sold a business or they've sold some real estate they've owned for a long period of time. They do not want to pay the taxes. So they're not looking at the cash flow. They're not looking at the ultimate IRR. They're looking just to protect their downside because they've already got such a step up in their basis.
Yep.
And that is what I see the most critical in terms of when someone coming in, like, how the hell do they pay that for that? Like, it doesn't make any sense. So that's to me what I see. The other thing is off-market deals. I'm dubious on them sometimes now in this particular market, because when you have other people and you know where you're coming in at in the stack, you know that 4 or 5 other groups will pay $30 million or $35 million. If you've got one high flyer at $40 million, okay, here's a high flyer. But at least you know you didn't do anything stupid with your underwriting, that there's other people out there who are willing to pay the same amount or within a spitting distance of where your offer is. When you're coming in with off market, you don't know what that market appetite is, right? You can only, like, if you get it at a good basis, that's fantastic. But there's a little bit of an element of, like, having on market deals means that you can prove out that you're not, crazy and overpaying for something, or you miss something in your underwriting and you're completely overshooting the rent projections or whatever it might be.
And when you say on market, you mean deals that actually have a price associated with them? Is that?
I mean, like, it's something where brokers like putting an OM together. They might have they soft launch it to a couple of people,
Yep.
and you come back and say, hey, look, I can pay 31 million. It's like, oh yeah, you're in the capital stack. You're probably third or fourth from the top. Like, okay, well, I'm not that far off. Let's see if I can stretch. It's where you hear the high fly coming in at, I'm at 30 million and there's someone's coming in at 35. You're like, I can't get that. I could maybe stretch to 31 or 31 and a half, but I'm not stretching to 35. And at that point, you're like, good luck to them. But you might also get the data out of the broker and say, well, how many other people around my offer? Like, how strong was my offer? It's like, oh, you're good on your hard money, you're good on your terms. And we had 3 or 4 other people that were in and around your area, your price. And you're like, okay, well, point proven. Good luck to this other person who's coming in and what I believe is overpaying for a deal in today's environment. And I will say to you, Kevin, that there's been deals that I've bid on in the last 6 months that we've lost multiple millions of dollars to, that are now coming back around and saying, hey, how's your offer coming at that 31 million now?
So they didn't trade. they didn't trade back then, and ultimately they came back around for one reason or another. It didn't sell.
Right.
To
but now my offer is not 31 anymore. Right.
That's it.
That 5% now gone to 6.5%. So my now offer is probably 29 or 30 million. And so we had a deal in Greenville that we really liked, 2004 build. They want 32 million for it. I'm like, it's probably worth 32 million in March this year. I can only pay 30 million bucks for it right now. And that's all I can do. So, yeah.
No, it's interesting times for sure. So your last question here before we wrap things up, Reed, really speaking to the more passive investors that are tuning into the show here. We get a good mixture of both passive limited partners that are looking to find quality syndicators like our group and your group, and then we get a lot of active guys as well. They're just really trying to figure out the latest and greatest strategies to implement into their own business. But again, speaking to the passive investors, what advice would you give them, those that are looking to really navigate what I see is a very busy sea of syndicators out there, so they can find the best group to fit their overall investment goals? Just any advice that you might share?
Yeah, look, I think it's 2 sides of the coin. The 2012 Jobs Act has created such an incredible marketplace for people to invest directly into sponsors like yourself and me. And so when I talk to people, I'm always saying, I'm not the only person in this space. I encourage you to go out and invest with multiple sponsors, because at the end of the day, you have the smorgasbord in front of you. So taking the money or the allocation, say you have $100,000 or $200,000, don't put it just with one sponsor. Go and test a few people out. Like, obviously get to know them first, get to know their investment philosophy, see if they've got a track record, see how they think about certain things, particularly in today's climate, because you're going to, as the tide rises and falls, you're going to see who's been swimming naked. I think you'll still, during these times, you're going to see who's worth their salt. But on the other hand, they have the ability to go and place their capital with a few different sponsors. And I see so many passive investors doing that. And I encourage it because it helps diversify them. I'm not in mobile home parks, but guess who I'm going to send them to? If I get someone who is, I'm going to send them to you, right? And, there's just, that's the ability. And me, I'm even an LP in some mobile home parks and some self-storage. I don't want to, do I want to be an expert in that? Maybe if I had the time, but I'm also investing my own money to diversify my own capital in other people's deals, because that's just the beauty of what's happened since the 2012 Jobs Act, the change. And I think that's only healthy for competition, for the market in general, and for investors to bring the power back to them to make that choice for themselves. But it does mean that they've got a little bit more work to do on their end to make sure that they're vetting the sponsors correctly, so they're getting into bed with the right group.
I agree. I appreciate that, my friend. For those that want to learn more about Reed, what you got going on, different offerings that you have that come to the marketplace, where's the best place to get more info?
Head over to rsnpropertygroup.com. That's R for Reed, S for Sophie, N for Nell, propertygroup.com. And if you're ever interested, to just hit me up and see me what I'm doing personally on the podcast, the books, you can go over to reedgoossens.com. That's ReedGoossens.com. And if you're ever coming through LA and you want to go for a beer or even a surf, hit me up at info@reedgoossens.com.
Can you get a beer and surf there after that?
Yes. We're going to have a lawn share on the Mall, and we'll try and do both at the same time.
Yeah, well, that's awesome. Well, appreciate it, my friend. Really good to see you again, and just congrats on the new addition to the family. You look good for having sleepless nights, so it looks like you guys are holding
the filters on
quite well.
The filters on, mate.
Yeah,
so.
Right. But no, it's always great seeing you, my friend, and catching up with you. So you take care, and wishing you all the best.
Thanks, buddy.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care.